right, so welcome everybody again for the weekly review. I think our goal today will be again the same in terms of trying to figure out where the markets are. And as I say always, right, it's always good to zoom out from time to time before we try to make sense out of day-to-day movement because the markets are noisy as we have been seeing. I think the volatility is rising. So let's look through the charts. I think as usual, what we do, which makes it easy to make sense. Uh, so I hope you can see the screen. So this was, I think, the SPX chart which we are looking at, and it's again, I would say, from a zoom out perspective, it looks like a sideways move, yeah, as we were getting used to last year. Of despite all the noise around tariff, despite all the questions, I think we were still in a very strong up move. What we are seeing now is that we kind of we hit a wall from a SPX perspective, and the reason being, as we always talk about, that we are going through a pretty severe tech correction. And when we say severe, means it doesn't show up at an index level sometimes because there's a lot more happening in individual stocks. But if you see, since the top formed in October, we could not break it. I think that's a story right now. Mostly it's around tech is struggling. Tech is big weight in SPX. So rest of the world, I would say rest of the market, like when you look at IWM, it is in uptrend. We are seeing the wider markets going up. Of course, they also need, ultimately, the fuel comes from the mega cap. The rally has to come from mega cap. So they are also right now kind of not able to break through. But in general, again, going back to what is happening. So I think as we were discussing, even in our macro group, the story till last year was AI is promising and whether it is hyped too much. And what we are seeing now is totally turning around, and we are saying that AI is probably going to disrupt a lot of existing companies, which is funny because I think it's a matter of how markets operate. Means market were leveraged, market were highly valued, and you will always see some reason to create panic, you can call it, or there's always this push to flush out excess leverage. So right now, I think that's what is going on. But the good news, I would say today, means again we tested 200-day moving average on this green line, which we track, which is usually considered a decent support level for Nasdaq. So I think there are some people, some analysts coming back and talking about why the whole tech scare is overblown. And I think we have been discussing this in WhatsApp group. If you are part of the macro group, we are talking very consistently around how it's not easy to just say that if AI can write software doesn't mean that you can displace a business, because it's much more than building a product, what it takes to run these companies. So I would say it's a more of a panic cycle which is going on, which we have seen, with we did talk a few times earlier, with what happened with Microsoft, like it is just going one way down, even though it's now taking some support and trying to reverse. We have seen how Meta has suffered, even though they have done great earnings. Most of their earnings have been great. We have seen even the semiconductor, which was earlier, I would say, the darlings of last 2 3 years of rally, whether it is Nvidia or whether it is Avago. I think we have seen some of these corrections coming in since I would say last 2 to 3 months. So this is, I think, probably going. We can call it as a excess resetting at the end of the year, where there was very big rallies in the last 2 years, and usually there's a lot more analysis which go around at the end of the year. And recently, I would say even somebody like Amazon, which is which broke through after the earnings, through its support levels, and it has taken a big hit. So we are seeing the cyclical selling in every stock which had not seen the correction yet. And this is something which is, I would say, the hallmark of last couple of months. And this is exactly what we are seeing. But on the other hand, a lot of people still wonder, so while the money has to stay somewhere invested, money has been rotating, and that's why SPX set up, because it's a 500 stock index. There are a lot more money going into other stocks when these mega caps are correcting. So that is a typical, I would say, consolidation, we can call it, at a market level, and more rationalization of the valuation of tech companies, which is now, earlier it was all bullish. Now it's more about considering the risks around them. But on the other hand, what it also means, most of these tech companies, if you look at just the forward PE basis, they are becoming very cheap. Like even from a PE basis, I would say some of them are below 30 now, and many of these are looking very promising. So It will be interesting how this, whether this today's flush what happened, and especially after we took support, because last week also we had tried to break through 200 moving average, which came back very fast. So every time we see bigger drops, we do see some buying coming in. And as we have been discussing, the VIX is definitely rising. So this means we are seeing more and more volatility. We are yet to understand whether it is because of the typical earning cycle, which is now behind us. So ideally, the volatility should have started to drop, but probably all these multi expiries we have talked about, right? So last 2 weeks, we are seeing that now that we have 3 times a week kind of expiries available for Mag 7, there is some impact of that. There is some, we are seeing the volumes rising in options. So that can be another reason. Only after, I would say, a few more weeks of data coming in, we can make sense out of whether this is creating, are we entering a period where volatility will remain high, or will it reset? Because ultimately the speculative layer, as we call it, right? There's a fundamental layer and then there's a speculative layer of, derivatives trading. We are seeing that is growing more and more. Like the volumes being traded on individual stock as well as index, they are actually growing every day, which can create maybe a little more noise in the market on a day-to-day basis. So that's what is happening. We did discuss, I think, a little bit before we started call. I think the question was about the Bitcoin. I would say from officially, means we have seen this, right? We did not take support here, and because of this drop, now we are basically in the typical bear market of Bitcoin. And yeah, but we always say, right, means it's a long-term trend, including some kind of corrections we had earlier. We go all the way back to 2022 timeline, where we had dropped all the way from the all-time high to like $15,000. I think that's the kind of trend line now we are tracking. And similar corrections, I would say, have happened before. It's not unlike Bitcoin. So the question here is whether this is the bottom or whether we have more drop left. And as we always say, right, means we only can see those things in hindsight. It will be very difficult. And we have also maintained that you cannot sit out if you have an allocation. You cannot sit out either, because as we always know that some of the best days, if you take out from any of these asset classes, you may basically don't gain much. So when they go up in a similar fashion. And it's more about managing your risk in the short term. You should not have allocations which are way beyond what you can handle in the short term. So that's how we always recommend. But overall, yes, it has been one of the, I would say, underperforming asset in last few months, and it is getting beaten up. And but then recently, I think the liquidations and the oversold levels on Bitcoin are showing that there is some chance of taking support. And this was also the area where previously, as we have seen, all-time highs were broken out of here, and there was a pretty decent support in this area. So we'll watch, I think, over the next few weeks whether it really turns around from here. And as we all typically what we say is the first resistance is always the previous breakdown. So we still are way away from showing any kind of confirmation. It has to go above $80,000 before we even start talking about reversals right now. Similarly, I think volatility was very much visible in gold and silver. We are seeing since that big flush out of gold, it is trying to continue on the uptrend, because as we all know that gold has a pretty solid narrative around the sovereign buying and the anti-dollar trade. And I think that trend is still, you can see here, the trend is pretty much there despite the volatility. And we need to see whether it continues or whether this top we formed earlier this year, which is around 5,500, will it stay as a top for this cycle? As I always say, that when the slopes become very steep, one has to be careful. It's not easy to trade around, and you definitely need a lot more hedging if you are trying to trade for short term. Now, silver, which is maybe a little more speculative in terms of how it behaves, usually in the late phase of any gold rally. I think it is showing, again, long-term trends will always look good because of such a huge rally. But I think it is not looking good in short term, that it may actually take support much lower, even if we are talking about long-term trends. So again, I think as we all, this is all about silver. It's usually higher beta than gold. And if you see some of these volatility, which we are seeing in these asset classes, are reflecting how much derivative volumes are being traded on top. We had been warning a lot of our subscribers, or also in the macro groups, around this period when we saw the signs. And I think since then I think we have seen those kind of corrections which are happening here. Again, in short, I would say that market is not breaking down for sure. Like if you look at just the SPX, it is more like a um, sideways move. Nasdaq is still in correcting, still above its 200 moving average, which means it is just reversing to the mean for now. It's not either breaking down. While we have seen Bitcoin breaking down and we have seen gold being, going through bigger corrections. So this is where overall situation is. Money is rotating into smaller caps. Money is rotating into the rate sensitive sectors. And that is one thing which I would like to highlight then is let's look at the yields, because this was one of the big concern going into, I would say, start of the year when yields were rising. And what we are seeing is that they're dropping very hard. And as the more and more data is coming out, which we had always believed and we have been discussing in our macro groups and our subscriber groups, that how we believe that inflation is on the way down. And today, I think the CPI numbers confirmed that again, that we are in a pretty stable environment. The tailwind of the some of the components of inflation, which is measured, we understand those. Like we understand that why they were expected to go down. So overall, I think this is going to be interesting macro cycle now that we have expectations of rate cuts again rising. We are again seeing people are talking about 2 to 3 rate cuts this year. That in that kind of, I would say, easing cycle, we can expect maybe a lot more. At the top of the market, it's very rare that we have prospects of these rate cuts and so on. So I think that's where this narrative can shift very fast as market finds the bottom, as some of these tech worries go away. And again, we did talk about it last week that even from a tech perspective, almost all earnings were great. Like there was nothing which is showing you fundamentally there was any problem. Even though the earnings were great, we are seeing big corrections. That is because, as we say, right, that it's a market decides to not support those valuations. You can always create stories around all the panic around, whether AI will eat it or all kind of anything which you can find will be used by market makers to go and manipulate the market in short term. So having said that, I think it's very interesting. Like if you see even from any story which has come out in last few weeks, there's no reason to say like for Nvidia to fall, for example, because Nvidia, Vago, we are talking about capex expansion of 200 to 300 billion from last year to this year. Why were these stocks priced so high last year versus now? So fundamentally, you cannot even justify these things. So this is why we need to understand this whole market cycle of how the whole leverage cycle can blow up the prices and can depress the stocks for much longer than what the fundamentals suggest. So this is why it's very important to build a little longer term plan, not worry about short term movements, which is what we are seeing in some of these stocks, which have actually seen some of the most positive news in last few weeks, and we have not seen any reaction here at all. So I will stop here and probably take a few questions, but just again highlighting the fact that we did expect volatility to be high. We did expect market to be a little indecisive. This is what we discussed in our investor day also. But on the other hand, the fundamentals are similar to what it was a few years ago. The only difference being the valuations were high, and that's where these short-term corrections become a norm in the market. So I'll stop sharing here and maybe we can have a quick few questions if there are any in the chat. So I see a question here regarding the new Fed chair announcement, Kevin Warsh, as a factor for driving gold, silver down. Yeah, so I think market is trying to analyze, or sometimes it's over-analyze impact of these kind of policy decisions, like decision makers' appointment. And Kevin Warsh is probably, I think there was a recent analysis I was reading that he has been moving around in terms of his views very frequently. So it's not like some of the views which are the market was analyzing was very old, the public statements. Definitely, he has been consistent on a couple of things. One is that he always advocated for stronger dollar, less QE. So that was the first concern from market, and that was one of the reasons why some of the it was attributed, the gold and silver drop was attributed to him. But having said that, like that may have triggered a panic for a 1 day or 2 day, but there's no real evidence that he's going to act anything different. Um, there are multiple reasons for it. One is that most of the hawkish or statements being given by or the attribution of the statements from Kevin Warsh, where market was reading into, were like probably 15 years old or like very pretty old data. And as you know, like world changes around so fast these days that they have no meaning. Secondly, um, Trump has been openly talking about how he wants lower rates. He has spent a lot of time personally on this appointment. So I would say this is not something which means is up for even discussion. Our expectation is that the rate cuts are on the table. And secondly, it's not like just one Fed chair or somebody. Like there are 12 people who vote, and there are other Fed governors who also have to be aligned on the softer policies. So yes, I would say that all drop which happened in the gold, silver, or any kind of asset classes, that was purely because of leverage. Um, yes, 1 day drop or 1 day panic can be created because of a news. Similarly, like what we are seeing in the tech stocks, right? Because the leverage is so high, just one panic and one trigger can liquidate so many people, that the drops become 10, 20% within a single day. And that is not because the valuation goes down so fast. That is because we have so much derivative volumes being traded, so much margin being used in the modern day, that the moves are bigger. And similarly, we see the moves up are also very big sometimes, which was never the case in old days. In old days, it always used to be that you fall very fast and corrections are fast, but it takes a long time to go up. But nowadays, you see even the up moves are 5 to 10%. So I would not read too much into the size of the drop, or because gold and silver dropped after his appointment or his nomination, actually not yet appointment because he has to be confirmed. But I would say that these can be triggers which can be used. And from our analysis is very simple, that at least the rate cuts are definitely on the table. We are seeing more and more data, like whether it's unemployment, whether it is the CPI. There's nothing which is a blocking point from rate cuts. And I think more and more, there's a very high chance now that even before Kevin Warsh comes and takes his position, we might have one rate cut with Powell also. I mean, that is just plainly because of the data. So I think that's what we are expecting, but it's more about the fundamentals are not driving the market anyway, right? Means when we start seeing the volatility which we are seeing right now, it's not necessarily because of that. All right, so let me take some other questions. People with income below 70 have increased credit card debts. This travel is slowing down. Yeah, so I think that's a fair point. I would say this wider economy was actually struggling for quite some time, and probably we are hitting those points where the stress is going to keep increasing. But I have not seen any data, whether it is the debt, the credit card debt, or whether it is the delinquencies which we have been looking at for quite some time. There's nothing looking like a systematic risk right now to the economy. Secondly, remember that the rates are coming down, and when the rates are coming down, you can always like there's a lot of flexibility which banks have, even if there are bad debt or something, that nobody likes to take losses on their books, and they'll tend to rework those debt. And when the rates are coming down, they have even more flexibility to further define those payment plans and so on. So I'm assuming that is going to be like as we are seeing. By the way, I was reading a few reports in last few months around the commercial real estate. Like if you remember in 2023, the common narrative was that because of the high rates, within a 12 to 18 months, a lot of commercial real estate will be go bankrupt, and people like Blackstone and all, they will start losing a lot of money. They did lose money, but that never stopped the market from going up, because that was maintained very well, that was controlled. And the refinancing kept on happening. And now that we have seen the rates starting dropping, we are seeing some of these valuations of the commercial real estate is again going up, because that was the biggest bottleneck for that sector, as the rates were very high. So I would say the rate cuts will definitely help almost all of these economic uncertainties which we had in terms of various kind of debt. I think in last 3 years, I've heard almost every kind of conspiracy theory around how the biggest black swan will be first commercial real estate, then the auto loans, then the personal debt. But again, as we say, right, as soon as the rate cuts started happening, I would say my concerns are less and less now, because there will always be a way to manage them if the rates are coming down. Um, and they can always redefine those. So I think overall, and we did discuss even during the investor day, and we had shown some of the projections. Wider economy, the wider small caps, they're all expected to have a very high increase in earnings this year, purely because they are very heavily dependent on debt, and they are seeing the debt price coming down, like the cost of capital is coming down, and that I think is a very big stimulus right now in the economy. Already we have done 6 rate cuts in last 2 years, and I would say if there are another 2 to 3 rate cuts which are expected this year, by end of the year, the situation on wider economy will definitely be better. So I think plus the inflation now is looking like in control, even though we always believe that those are made up numbers in terms of the basket chosen. But I think that does matter for somewhat, because at least the energy prices are in control, the rental prices are in control. I think the only other concern would be the because of the immigration being negative right now in US, the wage pressure can show up again. So I would say the inflation, at some point, I would say inflation can come back if the rate cuts continue. And but I think usually that's a lag factor. So my assumption is, from a policy perspective, they're trying to get to the best condition by end of this year, because that's one of the biggest elections in the midterm for Trump, and they will try to make sure that there are best conditions by end of this year. So I would more worry about worsening of situation next year rather than current year. I think there is a lot of they will continue to do stimulus and all kind of rate cut push in next few months. And by the way, rate cut is one thing, right? We did talk last year about how they have done the SLR ratios, and they have changed a lot of other parameters to make money easy. So those things still exist. I don't think there is any negative effect of those. Like everything is positive from a policy perspective to help ease some of these conditions in the wider economy. So I think those tailwinds are still with us. The market is just getting too focused right now on the tech losing steam because of what is happening with some of these AI narratives. And again, these are, means, I don't think that it is, again, my summary from that is that it is not necessarily very, very like kind of negative news. It's more around they're just using this news to flush out the leverage. All right. Any other questions? Feel free to unmute yourself as well so we can take those. Okay, I think there is a, yeah, go ahead. Yes, so I think I don't see any other question in the chat. So we have, I think, by the way, so just a quick note that you all know that it's a long weekend coming up now. So the volatility which we saw last couple of days, there were a lot of undertones in the community. Like when I talk to the traders and so on, like some of our in the industry people, we are also seeing that there was somewhat of a unknown of because of the typical policy changes, especially some of the geopolitical things which are still sitting unresolved, like what is happening with the escalations which Trump has done in Iran. There have been a few concerns around that. And there were few other things which were being discussed. So I think what you saw last couple of days, there is a lot of unrolling of those that leverage which happens whenever there is a uh, like these kind of longer weekends, and the market makers are trying to make sure that they don't carry any major directional kind of impact which can happen in a gap up or gap down kind of scenarios. So those kind of things can add up to volatility. So I think one of the things which I was hearing is that this typically, like what happens is, we have seen the Thursdays the volatility spiking, and the Fridays it comes back, and today we saw the volatility staying still higher than what we usually are used to at the end of the week. I think that is one of the factor which was playing out. So, and also we lose one of the this max 7 expiry days which were there on now the Monday and Wednesday, which we have started seeing. So that is, there are some impact which we are seeing in short term. So those kind of things is very getting very interesting, and especially with us being in very actively in the options world, we are studying the data. We are studying a lot of we are discussing with other industry people and trying to understand what's going on. But in general, I think the feeling is that volatility will be higher because of more betting. Like now we have every expiry comes with its own volatility around it because there are a lot of bets happening on Monday and Wednesday now in Mag 7 beyond Fridays from retailers, from a lot of other retail investors and speculators. So that is where I think one has to probably be prepared till the market makers adjust to it and try to smooth it out. There are a lot of new things happening in the market right now, which are not the case like earlier. Like we have last week we talked about how people are also trying to define some of the tech valuations in the context of the new debt being raised, and so there are multiple such things, right? So there are a lot of unknowns which have started this year, and the surprise is.
Okay.
Um,
So let's go get your bedding.
I'm sorry, guys. Please stay muted if you are not talking. Okay. So yeah, so I think we were talking about those. So next week we do plan to show some of that data which we are reviewing right now. So as I said, right, means there are on the tech stocks, there's some questions which were being asked to one with to me, and some of our subscriber forums were, what is what is causing this kind of a unrest. So we did talk a little bit last week about that how the debt increase in tech is way beyond normal in terms of growth sizes. And this week, we are also seeing the impact of some of these volatility layers, right? With some of these speculatory layers of Monday and Wednesday expiries on Mag 7. So all these together are creating a little bit of uncertainty in two factors. One is fundamental in nature, which is the valuations because of the additional debt. And the second is the whole day-to-day market moves from the market makers. So these two things we are analyzing at our end, and we do have some interesting insights coming through those. So we do plan to share those next week. But in the meantime, people if you have any other questions if you're worried about day-to-day moves, what I would just say is that it might become a norm that we may have bigger moves in these stocks. And we have to just be ready for it and look at little zoomed out view of every position. The drawdowns and the big moves up and down can be bigger in this current cycle because of just that one reason, that we have a huge speculatory layer on top of some uncertainties which are cropping up. Um, and these are not very different, right? Means last year we saw what happened with whole tariff wars. Um, so if you zoom out a little bit, you realize that sometimes we end up reacting too much to day to day. So we just have to make sure that you have a plan, you have a view when you are making investments, which are little longer term view, and you're able to handle those moves within your parameters and be prepared for those. Like um, some of the stocks which moved, like Amazons of the world or Meta, like these are not normal moves. When you have, like, even after earnings, we never used to have 10-20% moves in 2 3 days. And those are the kind of things which means I think almost every stock is having right now. And you can see that those things can reverse also, but always look at bigger term charts and bigger term, you just zoom out for 2 to 3 years of chart if you're looking at the chart. That would be my recommendation.
Raman, quick. So in the insights, are you also going to present some of these wild variations around earnings in the specific insights or earning plays, changing the volume around those days, or
Yeah.
are you looking at that specifically? Cool, thanks.
So I think definitely we can try to show some of the data, but what I was trying to highlight is we were observing it. So very, very simple thing I can tell you is that the amount of open position or open interest which is changing around earning is going exponential right now. Most importantly, the non-sophisticated traders like the retail. That's the kind of data we are seeing. Like they are actually, the percentage of retail trading in options market is increasing very heavily. That creates sometimes opportunity for market makers to manipulate the market because they have a. When I say manipulate, of course, I will say with a pinch of salt, because of course, it's a very regulated market. They are not trying to do anything illegal. But what I mean by manipulation is that when they see excess positions, excess optimism or excess pessimism built up, they can short term take opposite position, and they can keep the prices suppressed, or they can keep the prices interesting for the retail, and draw them in and then liquidate them. Pretty much normal, pretty much used to happen all the time. But I think the size of retail positions being so big, that is creating even bigger opportunities for making money for these market makers. And that means that the swings can be bigger it can be wrong swings. Like, for example, if there is a 10% drop after earning, that may be purely manipulated to create a drop, and where they themselves are going to buy back very heavily, and they're just taking a short-term short position to liquidate retail. So those kind of things which we are seeing are basically going to, sometimes as a retail investor, you may get wrong signal that, oh, market reacted negatively. And unfortunately, the whole news cycle is designed to give a commentary on what happened. So what the typical news channels or the reports will do, they will try to justify why that 10% drop happened. But what we are seeing underlying is some of these things are purely because there were too much positions out there, which were there to liquidate, and they tried to move it in that position just because of that. Nothing to do with fundamentals, nothing to do with actual news. And those are the kind of things where you have to, that's why I'm highlighting that you have to have a big, longer term position, rather than thinking that you were wrong and the earnings really impacted the stock negatively, and you should not be in that stock. So that's
Right.
one thing I wanted to highlight.
One quick question. Are there any changes in data flows between these obviously brokers like Robinhood and Charles Schwab or things like that with to other banks? I mean, the whole order books are shared and sold, right, typically. And I was wondering if there's any frequency in that changed as well, or are they
Mhm.
providing more data now that they did not in the last few months? Or I don't know.
Yeah.
Just that also
I
is,
think
yeah.
No, I think nothing major in terms of changes. There are two things, as I said, right? So there are more and more opportunities to gamble. There are a lot more expiries now. That is one thing which changed. Second thing is the volume of institutional versus retail has flipped, where the institutions are usually less, conviction-based trades and more like, hedge trades. And you will see retail being purely one-sided trades, right? So that has been the norm, and the institutions used to dominate the trading market and the order books. What I'm trying to highlight is the amount of retail trading has increased in last 5 to 6 months, and it has become exponential in last 2 to 3 months. That has created an anomaly where institutions are trying to, create favorable situation for them by creating short-term bigger moves, and that is by definition, right? Means there are a lot of ways people try to explain it. One can be said that, okay, you are trying to flush out the leverage, you are trying to, liquidate all the dumb money out of the system, because we have got used to this continuous up move. Like last 2 years, it has been just buy the dip. Every buy the dip means that you will make money, and that creates this overconfidence in the non-sophisticated traders. And that's what is also one of the factors which is playing out here. What I wanted to highlight here is that. The takeaway is like it can get very technical if I start talking about those things in terms of the data we see. Like when you look at, we call it GEX data, which is anybody can buy it. By the way, it's not like it's any proprietary data. And these are mostly analyzed data, by the way. This is basically how do you separate out. So technically, if you look at order book, nobody can, there is no rule which says that you have to identify whether it is retail or institutional. Mostly it is proprietary data based on the signature, based on the size and so on, that these brokers and these analysts or the algo traders, they try to separate out. So there's most of these is proprietary. There is no special science behind it. But what I'm trying to highlight is I don't want to go into those details because that's what we do all the time at our end. What I'm trying to highlight here is that what is the takeaway? The takeaway is very simple, that sometimes this post earning or post news based moves, they are going to be much bigger in wrong direction for much longer, because there is a lot more money to be made. The cost of capital for these people is justifiable when there is so much retail out there to liquidate, and they can stay, opposite to the trend for some time, much longer, and they can manipulate. You can call it, if left for the lack of better words, the short-term price move in the totally opposite direction of what their views are. So institutions can do that because they have the size behind them, and that is what you have to be careful around, that you do not react that because a certain stock fell after earnings doesn't mean that the earnings were bad. It was probably there was leverage was too much positive, and they are trying to kill each and every leverage trader or the margin trader, and then the stock will go up later. So sometimes the reactions will be late and totally opposite of what you expect out of a certain earning or after of a certain news.
Yeah, got it. Thanks.
All right.
Yeah,
Okay.
there's
So
no
let's
regulatory
go ahead.
change coming. That's what I'm taking away as well.
No, there's nothing major changing other than I would say, more opportunities to bet and just the
Yeah.
retail being over leveraged right now
Yeah.
versus any time in the history. All right. All right, so let me take last one or two questions. So we'll post the recording for those who joined late onto the YouTube as usual, so you can go through that. But I think overall, as I say, like market is still pretty interesting. I think the macro is still pretty much in favor of better times ahead. But I think as we discussed multiple times this year, it will be slightly different path. It will be more volatile. It will be more selective, which stocks go up and which don't. So just stay aware and make a plan accordingly. And as I say, always say, right, in long term, markets always reward you for staying in the market. So try to make a plan which so that you don't take too much risk without having a very specific plan for long term. So with that thought, have a great weekend, guys, and let's catch up next week again. Thank you. Bye bye.